Good evening. We begin tonight with a comprehensive look at the latest movements across several key financial markets, as fresh data and technical updates paint a picture of shifting momentum in commodities and currency trading. Investors and market watchers around the world are closely monitoring these developments as they navigate what continues to be a dynamic and fluid trading environment. Tonight, we bring you the essential details on four major market instruments that have captured significant attention in recent trading sessions. These include the precious metals, silver and gold, the widely traded currency pair known as the euro against the United States dollar, and the agricultural commodity coffee. Each of these markets has experienced notable price action in the most recent intraday sessions, and technical analysts have issued updated forecasts that provide insight into what traders and investors might expect in the periods ahead. Our coverage tonight is based exclusively on the technical updates issued on the 4th day of February in the year 2026, and we will walk through each market development with the detail and clarity that these important financial instruments deserve. We start with silver, a precious metal that has long been valued both as an industrial input and as a store of value during times of economic uncertainty. According to the latest forecast update issued for silver on February 4th, 2026, the price of this metal has risen during its most recent intraday levels. This upward movement in silver pricing has been supported by what technical analysts describe as the emergence of positive signals coming from relative strength indicators. These indicators are tools used by market technicians to assess whether an asset is gaining or losing momentum, and in the case of silver, these signals have turned positive in the recent period. However, it is important to note that despite these positive signals, the relative strength indicators have reached what analysts refer to as overbought levels. An overbought condition typically suggests that an asset has experienced a strong rally and may be due for a pause or a pullback as traders take profits or reassess their positions. In the context of silver's recent price action, the metal has been retesting a significant psychological resistance level situated at $90 per ounce. Psychological resistance levels are price points that traders and investors watch closely, often because they represent round numbers or previous peaks that have proven difficult to break through in the past. The $90 mark is one such level, and silver's approach to this threshold has been accompanied by a retest of what analysts describe as the previously broken main bullish trend on a short-term basis. This suggests that silver had earlier broken above an upward trending line that had been guiding its price higher, and the recent price action has brought the metal back to test that same trend line from above. Such retests are common in technical analysis and can serve as confirmation of a breakout or, alternatively, as a point where the prior trend reasserts itself. Adding complexity to silver's technical picture is the fact that the metal continues to trade below a technical indicator known as the exponential moving average, calculated over 59 periods, commonly abbreviated as EMA 59. Moving averages are widely used tools that smooth out price data to help identify the direction of a trend, and the exponential version gives more weight to recent prices. When an asset trades below its moving average, it is often interpreted as a sign of underlying weakness or negative pressure. In silver's case, this positioning below the EMA 59 is exerting what analysts describe as continuing negative pressure, and this pressure is reducing the chances of a full recovery on a near-term basis. In other words, while silver has shown some positive signals and has been rising in recent intraday trading, the broader technical setup suggests that a sustained and complete recovery may be challenging in the immediate term. Traders will be watching closely to see whether silver can break decisively above the $90 resistance level and reclaim a position above the EMA 59, or whether the negative pressure will lead to a pullback from current levels. Turning now to gold, another precious metal that has been in focus. The latest forecast update issued on February 4th, 2026, indicates that the price of gold has declined during its most recent intraday trading session. This decline comes after the metal encountered resistance at another technical indicator, the exponential moving average calculated over 50 periods, known as EMA 50. Similar to the EMA 59 discussed in the context of silver, the EMA 50 serves as a dynamic level of support or resistance depending on whether the price is trading above or below it. In gold's case, the metal has run into this resistance and has been unable to push higher, leading to the observed decline. The technical backdrop for gold's recent weakness involves what analysts describe as the metal reaching exaggerated overbought levels compared to the price move. This means that the technical indicators used to measure momentum and overbought or oversold conditions had reached extreme levels that were not fully justified by the actual price movement in gold. When such exaggerated readings occur, it often signals that the market has gotten ahead of itself and that a correction or pullback is likely. In gold's situation, the metal has indeed surrendered to what is described as negative pressure, meaning that selling interest or profit taking has outweighed buying interest, causing the price to move lower. Technical analysts observing gold's chart have noted the dominance of what they call a steep bearish corrective wave on a short-term basis. A bearish corrective wave is a downward price movement that occurs after a period of gains, and it represents a temporary reversal or pause in the broader trend. The description of this wave as steep suggests that the decline has been relatively sharp or swift, and the fact that it is corrective in nature implies that it may be a temporary adjustment rather than the start of a longer-term downtrend. However, the immediate outlook for gold remains one of caution as the metal works through this corrective phase. Traders and investors in the gold market will be closely monitoring whether this bearish wave finds a floor and whether gold can stabilize and resume any upward momentum, or whether further declines lie ahead in the near term. We move now to the currency markets, where the euro versus the United States dollar exchange rate, commonly referred to by its ticker symbol EURUSD, has also seen notable developments. The forecast update issued for EURUSD on February 4th, 2026 reports that the price of this currency pair declined during its most recent intraday trading session. This decline has been accompanied by the beginning of the formation of what technical analysts call negative divergence on relative strength indicators. Divergence is a technical concept that occurs when the price of an asset moves in one direction while the indicators move in the opposite direction. And negative divergence specifically refers to a situation where the price may be making higher highs while the indicator is making lower highs, or similar discrepancies that suggest weakening momentum. The emergence of such divergence is often seen as a warning sign that the current price trend may be losing steam and that a reversal or correction could be on the horizon. In the case of EURUSD, the negative divergence has begun to form after the currency pair reached overbought levels. As with the precious metals discussed earlier, overbought conditions in a currency pair can indicate that the asset has rallied too far too fast and may be due for a pullback. The update notes that these overbought levels were reached exaggeratedly compared to the price move, suggesting once again that the technical indicators had become stretched relative to the actual price action. This exaggeration has been accompanied by the emergence of negative signals from the relative strength indicators, reinforcing the view that downward pressure is building. Adding to the bearish technical picture for EURUSD is the fact that the currency pair continues to trade below the exponential moving average calculated over 50 periods, the EMA 50. As we have discussed in the context of gold, trading below a moving average is generally interpreted as a sign of weakness or negative pressure. For EURUSD, This positioning below the EMA 50 means that the currency pair is facing ongoing headwinds, and this negative pressure is contributing to what analysts describe as the dominance of a bearish corrective wave on a short-term basis. This bearish corrective wave in EURUSD is similar in concept to the one observed in gold, representing a downward adjustment after a period of gains. The outlook for EURUSD in the near term is therefore one of caution as the currency pair navigates this corrective phase and traders watch to see whether support levels will hold or whether further declines are in store. Finally, we turn our attention to the agricultural commodities market, specifically coffee, where recent price action has validated the expectations of technical analysts. The forecast issued for coffee on February 4th, 2026, reports that coffee prices have successfully activated what was previously suggested as a negative trend. This activation occurred when the price moved below a key support level, identified at 334.20. Support levels are price points where buying interest has historically been strong enough to prevent further declines. And when a support level is broken, it often signals that the balance between buyers and sellers has shifted in favor of the sellers. In the case of coffee, the break below the 334.20 support level has led to what is described as a strong decline, with the price achieving an initial target by reaching the level of 314.85. The movement in coffee prices represents a validation of the bearish outlook that technical analysts had previously put forward, and the strong nature of the decline suggests that selling pressure has been robust. The forecast update provides additional context by noting that stochastic indicators, another set of technical tools used to measure momentum and identify overbought or oversold conditions, have stabilized within the oversold level. When stochastic indicators remain in oversold territory, it can indicate that selling pressure continues to dominate and that further downside may be possible, even though the asset is already at depressed levels. In the case of coffee, the stability of the stochastic indicators within the oversold range is expected to increase the negative pressure in the current period, which could lead to the formation of new bearish waves. Looking ahead, the forecast for coffee suggests that the next downside target is situated at the 308.00 level. If this level is reached and breached, it would put pressure on an even lower support level at 300.50. The analysts indicate that breaking below 300.50 would provide what they describe as an exit for resuming negative trading in the upcoming period. This language suggests that a break of the 300.50 support could open the door to further and potentially more sustained declines in coffee prices. For traders and market participants in the coffee market, these technical levels are being watched closely, as they will provide important signals about the strength and durability of the current downtrend. The expected trading range for coffee on this particular day is identified as being between 300.50 on the downside and 325.00 on the upside. This range provides a framework for traders to understand where prices are likely to fluctuate during the session, and it reflects the current technical setup and market sentiment. The overall trend forecast for coffee is clearly bearish, indicating that the prevailing expectation is for further downside in the near term, unless there is a significant shift in market dynamics or the emergence of new information that changes the technical picture. As we have detailed, the financial markets for silver, gold, the euro against the United States dollar, and coffee have all experienced significant technical developments in recent intraday trading sessions. Silver has risen but faces resistance and negative pressure from its position below a key moving average, reducing the likelihood of a full near-term recovery. Gold has declined after encountering resistance and reaching exaggerated overbought levels, and is now navigating a steep bearish corrective wave. The EURUSD currency pair has also declined, with negative divergence forming and the pair trading below its moving average, leading to a bearish corrective wave. And coffee has activated a previously anticipated negative trend. breaking below key support and achieving initial downside targets with the potential for further declines ahead. These updates are based solely on the technical analysis and price action observed as of February 4th, 2026, and they provide important context for traders, investors, and market observers as they assess their positions and strategies in these key financial instruments.